Long before banks carried polished marble floors or digital screens, a quieter revolution was shaping the world's destiny. Interest did not begin as a rule written by powerful institutions. It began as a human attempt to control the unknown. In ancient Mesopotamia, when farmers borrowed grain, they weren't simply asking for food. They were asking for a chance against nature itself. Seasons failed, storms ruined fields, and hope was often the only currency people possessed. To guard against this uncertainty, lenders added a small surplus to each agreement. What started as a modest safeguard slowly transformed into a radical idea. The future had a measurable cost. Temples and early trade houses soon realized the power of documenting these exchanges, giving interest structure, permanence, and authority. Over time, the mechanism evolved into a silent force, threading through every marketplace and kingdom. Those who understood it could influence behavior, shape economies, and steer civilizations without ever lifting a sword. Interest became more than a financial tool. It became the hidden architecture of power, turning time itself into something that could be bought, sold, and controlled. Long before modern banking towers shaped city skylines, power quietly shifted into the hands of a new class, the early bankers. They were not politicians, kings, or warriors. They were record keepers who understood a truth others overlooked. Information could become wealth. In ancient temples of Babylon and later in the trade houses of Florence, these financial pioneers kept meticulous clay tablets and ledgers tracking every loan, every promise, and every grain of interest owed. What began as simple bookkeeping soon evolved into influence. People depended on their calculations to plant, to trade, and even to survive harsh seasons. As wealth flowed through their hands, something extraordinary happened. Trust transformed into authority. Communities realized that whoever managed the flow of credit indirectly managed the rhythm of life itself. Early bankers discovered they could shape markets by adjusting the terms of lending, favoring certain merchants or supporting ambitious voyages. Their ledgers became invisible maps of power, records that determined who rose, who failed, and which cities flourished. Without armies or crowns, they guided the direction of economies, proving that numbers could conquer more effectively than any sword. This was the moment when banking stopped being a service and became a foundation of civilization. The rise of the Medici family marked one of the greatest turning points in financial history. In 15th century Florence, wealth no longer came only from land or armies, but from the mastery of numbers. The Medicis understood something their rivals did not. Money could move power more swiftly than any soldier. They created a network of branches across Europe, allowing merchants, nobles, and even popes to move funds without carrying a single coin. Their innovation, the double-entry ledger, allowed them to track every debt, credit, and interest payment with unmatched accuracy. Gradually, their influence expanded beyond banking. They financed artists, shaped politics, and guided wars from behind velvet curtains. Florence prospered, but more importantly, a blueprint for global banking was born. The Medici name became synonymous with a system where information, secrecy, and trust were more valuable than gold itself. Their empire proved that the world could be governed not only by kings, but by bankers who controlled the invisible currents beneath every trade and every decision. As kingdoms grew larger and wars became costlier, rulers discovered that traditional treasuries were no longer enough. This need gave rise to one of the most influential inventions in economic history, the central bank. The first prototypes appeared in 17th century Europe, where governments partnered with wealthy banking families to manage national debt. These institutions introduced a radical idea. Money did not need to be backed by gold, it only needed trust. By issuing notes, controlling interest rates, and coordinating lending, central banks gained the ability to guide entire economies. Their decisions determined inflation, prosperity, and even political stability. Over time, kings relied less on armies and more on these financial architects. A new form of authority emerged, one that did not command with swords but with policies capable of lifting or collapsing nations. The world began shifting into an age where power flowed through vaults, not thrones. By the 18th century, interest had evolved from a simple surcharge into an invisible empire shaping global decisions. Nations borrowed to build fleets, fight wars, and expand influence. The lenders, however, were often private banking dynasties whose names rarely appeared in public. Their leverage came not from military strength, but from their ability to determine the cost of national survival. If a king wished to wage war, he depended on them. If a nation faced famine, reconstruction, or crisis, they dictated the terms. Interest became a quiet instrument of negotiation, capable of rewarding allies and punishing rivals without any visible conflict. This period ushered in a new era, the age where financial influence surpassed political power. The world was learning that the true battlefield was not land, but debt, and interest was the weapon that decided who won. There are moments in financial history when a single decision quietly reshapes the entire world. One of these moments came when early European bankers realized that money didn't need to exist physically to hold power. Instead, it could be represented, promised, or projected. This shift allowed banks to operate beyond the limits of gold and silver, creating a system where numbers carried more weight than metals. The concept of trust became the backbone of finance, but it was trust controlled by institutions, not individuals. As paper money spread across continents, people unknowingly surrendered authority over the value of their labor. The modern interest system grew from this transition, turning banks into architects of economic destiny. The true rise of banking power began when institutions recognized that loans were not transfers of existing money, but the creation of entirely new purchasing power. With each promise of repayment, banks generated currency that had never existed before, shaping economies through the sheer authority of their signatures. This ability allowed them to influence governments, industries, and ordinary citizens without raising armies or occupying land. Every loan came with interest, and every interest payment deepened the borrower's dependence. Individuals organized their futures around repayment schedules, while nations financed wars and infrastructure through obligations that lasted decades. As this system expanded, money became a fluid idea shaped by confidence rather than tangible assets. Banks evolved from financial participants into silent architects of economic reality, designing systems where the flow of credit dictated the pace of civilization itself. Interest eventually transformed into a force that subtly directed the rhythms of everyday life. People worked longer hours, built careers around debt cycles, and accepted financial pressure as normal. Governments also surrendered to the system, using borrowed capital to fund growth, conflicts, and public projects. This created generational obligations passed from citizens to their children. Over time, societies measured success not by wealth earned but by debt managed. This structure created a psychological architecture where progress was intertwined with borrowing, and security became tied to credit scores. The deeper the world descended into interest-based systems, the harder it became to imagine alternatives. The global economy began breathing in harmony with the pulse of debt, reinforcing a cycle where growth required constant expansion of credit. Interest became an invisible tax on time, shaping entire civilizations without raising a single voice. As financial systems matured, interest evolved from a practical tool into a mechanism that shaped global behavior. Banks discovered that by adjusting interest rates, they could influence the direction of entire economies, encouraging spending, slowing markets, or redirecting capital flows. This power created a delicate balance where nations could rise or fall based on decisions made behind closed doors. Over time, interest stopped functioning merely as compensation for risk. It became the steering wheel of the world economy. citizens began to live in cycles defined by mortgages, student loans, and credit obligations, unknowingly synchronizing their lives with the strategies of financial institutions. The more interconnected markets became, the more powerful this influence grew. Interest turned into a subtle form of governance, shaping choices not with laws but with incentives. In this invisible system, those who controlled the cost of borrowing shaped the rhythm of progress itself, guiding societies without ever appearing on the public stage. The globalization of interest-based banking created a world where economic fate became increasingly interconnected. A decision made in one financial center rippled across continents, influencing currencies, markets, and governments everywhere. As multinational banks expanded, they gained unprecedented reach, extending loans to emerging economies and shaping the development of entire regions. These nations often found themselves in cycles of dependency, using borrowed capital to fund improvements while sacrificing autonomy through long-term obligations. Interest became a quiet force determining which countries advanced and which remained stagnant. Meanwhile, ordinary people experienced the system through rising prices, unstable markets, and the constant push to borrow in order to keep up. Global finance evolved into a complex machinery where interest was the engine, driving expansion but also creating vulnerabilities. A single shift in that engine could accelerate prosperity or trigger crisis, proving that the world had become fully synchronized with the heartbeat of debt. As digital technology emerged, interest systems adapted and grew even more influential. Algorithms began calculating risk faster than humans, determining who could borrow and at what cost. Every online purchase, every financial decision, and every data point fed into a vast network that shaped personalized interest rates. Individuals were no longer judged solely by income. They were evaluated by patterns, behaviors, and digital footprints. This made interest deeply personal, turning it into a mirror reflecting one's financial identity. At the same time, digital banking accelerated money creation, enabling institutions to lend at unprecedented speeds. With each virtual transaction, the line between real value and algorithmic projection became thinner. The world entered an era where interest was no longer just a financial factor. It was a digital pulse, constantly adjusting and reshaping the trajectory of modern life. In this environment, the cost of time itself became programmable. Today, the interest system stands as one of the most powerful structures ever created, shaping nations, influencing people, and directing the global economy from the shadows. Yet, its greatest strength lies in its invisibility. Most people never question why they borrow, why they pay, or why the system functions as it does. Interest operates like gravity, silent, constant, and profoundly influential. But as economic pressures grow and technologies evolve, new questions arise about the sustainability of a world built on perpetual debt. Some envision a future where alternative financial models challenge traditional structures. Others believe the current system will tighten its control. Regardless of direction, one truth remains. Understanding the origins and mechanics of interest is essential for navigating the future. Only by recognizing how time, trust, and power intertwine can societies redefine their financial destiny and break free from cycles they once believed were unchangeable.